we're going to hear from Ray DeWitt, who's been in the finance and real estate industry for 25 years. He's an expert in DSTs, so let's learn about him. All right, I'm super excited to invite Ray DeWitt from Bangerter Financial. Thanks, Ray, for hopping on the show.
Yeah, you're welcome, man. You nailed it. Good job.
Yeah, we were talking beforehand on how to pronounce the name. I guess it's a popular name out in Utah where you're at, but out here it was a difficult one. So thanks for walking me through it. So Ray, before we get started, I know it's a highly regulated industry. What are the standard disclaimers you got to give us?
So first of all, I got to say you have to be an accredited investor to invest in these products, which is $1 million net worth or 300,000 joint income per year, or an industry professional. And this is not a solicitation. I'm not referencing any offerings. I'm not trying to make a sale to you. This is purely for educational purposes only.
Perfect.
Yeah,
I wanted to dive into it. I mean, look, you're managing director of the firm, and definitely wanted to dive into your specialties, which are DSTs. But maybe before we dive into that, you could give us a little bit more about your background and how you became an expert in DSTs and what you do now.
Yeah, I mean, my background is I kind of stumbled into financial services industry in my early 20s. So this is actually my 25th or 26th year in the industry. I'm a fiduciary. I'm securities licensed, insurance licensed, real estate licensed, concealed firearm license, lots of licenses. And, your typical traditional financial planner for years. And several years ago, eight or so years ago, I kind of had an epiphany of, what kind of midlife career crisis, what do I do? And kind of burnt out on Wall Street. And it occurred to me that all of my wealthy clients, all in real estate. In fact, almost all of their wealth was in real estate. I didn't have customers that had 10, 20, $30 million in the stock market, but they did in real estate. And I kind of got looking at, well, gee, some of the best returns I've ever really had was in real estate. So why am I selling mutual funds to people every day? And I started learning about the various real estate options available that people can do that are passive investments, and kind of grabbed hold of it. And lo and behold, years later, I'm literally one of the leaders in the nation in the Delaware Statutory Trust market. It's been a wild ride and a fun ride. So I call my kind of self the real estate financial advisor, specialized in tax strategies. So the 1031 exchange Delaware Statutory Trust is definitely 75-80% of my revenue. That's coincidentally because they tend to also be larger sized deals. But we do partnerships, REITs, opportunity zones, oil and gas drilling funds, solar funds, financial planning still do, help people with that. But definitely the 1031 DST is the dog, not the tail, like however that saying goes. So,
Yeah. So although your firm, you guys do a lot of different financial instruments, but you specialize in the DST, or do you still do those other things as well?
we do. I mean, I do everything. I am very focused on the real estate end and things. As I said, the Delaware Statutory, just due to the nature of, it tends to be a larger transaction. So who doesn't like more money?
Yeah, yeah.
So, but I help people self-directed IRAs. If you just want to have some cash, you want to invest in passive real estate investing. Just like I'm an investor with CSQ. I'm excited, looking forward to it. I also have similar opportunities for people from firms all over the country. But once again, the 1031 exchange product is definitely king around here, at least.
Cool. Well, I love it. I'm glad I'm talking to the official expert here, because my thought on this show is to kind of educate people a lot more about the DST. A lot of people know about the 1031 exchange, at least in our real estate world, and a lot of listeners will be pretty familiar with that. But I wanted to dive into your product a little bit more, the DST, and how that might be a solution for certain investors. So maybe we could start at the beginning. I know it's kind of elementary for you, but maybe explain a little bit more about what a DST is, how they operate, and how it's similar and different than a 1031 exchange, or how it's used in a 1031 exchange.
Right. So a DST is short for Delaware Statutory Trust. As I often say, DST is spelled Ray, R-A-Y,
I
and
love it.
Ray is spelled DST. Anyways, Delaware Statutory Trust, not to be confused with the other DST, the Deferred Sales Trust, which is a completely different animal. The DST is a real estate-based syndication, and it actually has the special blessing of our benevolent IRS as eligible for a 1031 exchange. So it looks like a REIT from 10,000 feet or a partnership. Sure feels like one. There are very many distinct differences in the way, especially in the way it's structured, the way the money is raised. But in effect, it does really, for an investor, feel very much like they're just in another partnership or a REIT. And it's typically, due to the nature of the DST, it's typically very high quality, Class A, low risk real estate. With a DST, you can't do a fix and flip, you can't develop, you can't do a deep value add. So it tends to be newer properties that are fully stabilized, have very little, if no maintenance needed. You can't, the IRS does not allow you to replace the debt or refinance the debt or do a cash out. There's some handcuffs on it, which tend to lead once again to very newer, stabilized, conservative properties. I tell people this is more of a keep you rich type of an investment than a get you rich investment. Not that they don't make money, but you know what I mean. Hopefully, and so a lot of the properties are things like an Amazon distribution warehouses are strangely very common asset owned by a DST, but we see a lot of apartments, the storage, almost every asset class you really can think of is available. And these are properties throughout the country. Every DST has its own tax ID. It's its own entity. If the property inside the DST is sold, it actually dissolves the trust, and the capital has to be returned to the investor, who can do another 1031 exchange into whatever they want. So a DST, it's done the same as any other 1031 exchange, just easier. These properties are in place. This is a done deal. You're not doing an inspection report. You're not applying for financing. If you're looking to finance it, you're not doing all the environmental reports. It's all done. It's a package, and you literally just invest in it, walk away. You get immediate income. It starts literally the next month. It's fantastic for people who, I like to say, are tired of the tenants, toilets, and trash. If you don't want to be a landlord anymore, you need to call me. I can help you solve that problem. Defer the taxes, stay invested in real estate, keep your money working for you, and continue to get income. You get all the same tax benefits you would in real estate. If the DST does a cost segregation analysis, you're going to participate in those benefits. And it really, literally is fractional ownership. Just like any other syndication, partnership, REIT. And I brought up earlier debt. One of the superpowers of a DST really is the debt replacement factor. So, Chad, in a 1031 exchange, if you sold a $2 million property, but you had $1 million mortgage on it, right? When you sell it, you're paying off the mortgage, you got $1 million in equity. Well, the IRS says that's great, but you've still got to buy $2 million worth of real estate via the 1031 exchange rules. Well, okay, how do you do that? Well, you come up with another $1 million out of your pocket, or you go get a loan. Right now, loans aren't so wonderful to have at 8 and 9% interest rates. Very challenging. But with the DST, just like any institutional professional investor, they often use leverage. We all use leverage when we buy properties, right? 40, 50% responsible leverage. Let's use the bank's money, make some money on this property. And the DST does the same thing. And so when you buy into the DST, the units of the trust, you're buying the units. Every unit has so much equity, so much debt on it. And that debt is non-recourse to you. So it is no credit check, not on your credit report. Heaven forbid the deal go bankrupt. You don't have the bank knocking on your door wanting their money, right? The IRS actually, however, gives you credit to the debt. So you kind of get most of the benefits or all the benefits of debt without most of the risk. So in my scenario where you sold for 2 million, you got 1 million left. Well, if you come to me, Ray, I got to replace this mortgage. Let's find a DST that's 50% loan to value. You put your million in, it buys $2 million of real estate, right? Million leveraged, 1 million unleveraged. The IRS gives you full credit for that.
Got it. So how does it work?
And
It's interesting because you're saying that you could come in after the deal's already solidified and stabilized and going forward. So is a new investor in a DST, are they kind of backfilling some equity position or like how does that work?
it's almost from a syndicator's point of view, it's almost the opposite. I'm going to go out, I'm going to buy the property. I'm going to use my money, I'm going to use a bridge loan, and I put it inside the DST. Now, this 123 Main Street is owned by the DST. I give it, 123 Main Street DST is the name of it. And then how I'm paying myself back or paying off the bridge loan is I'm now raising capital and I'm backfilling.
Yeah.
And so, like a lot of syndications, like, hey, we're buying this property, we're going to make some improvements, then we'll start paying cash flow, or we're under contract to buy the property, but we need the capital to do it. This is the complete reverse. Already bought the property, finances in place, there's already tenants, there's all the due diligence has been done, it's ready to go. It's an operating, stabilized property. And we're basically, yeah, you're right, you're backfilling. It's sort of the opposite of every other capital raising product out there.
Yeah. So as the new DST investor gets a portion of equity, whatever money they put into it, if you're looking at a balance sheet, the equity of, let's say, Bangerter is going to be reduced by that amount. Whoever owned the property, whoever owned that part of the DST, they're kind of being bought
Yeah,
out,
so
if you will.
so, so there's a the majority of the firms that are doing this are multi-billion-dollar, very large national-based real estate firms. It's not, Chad, it's not just you and I putting together a property. We're talking some serious institutional money with deep pockets quite often. And yeah, so literally they would own the property, and they're basically just, yeah, their ownership of it's being reduced if you buy in, and that's the point of it. That they're paying themselves back for buying the property,
Yeah.
basically. It's a
Got it.
great way to exit a development as well. You could actually, as a syndicator, a real estate firm, you raise capital, you do development, do a project, a value add. The DST is a great way to exit
Yeah.
as well. You could sell your completed property to the DST. So there's a lot of really amazing things from a syndication standpoint that you can do with the DST, not just a retail investor standpoint as well. So
Got it. And do the same timeline rules that apply to a 1031 exchange? Is that all the same with it, whether you're doing a
identical.
DST or not?
It's no different. No
Yeah.
different. So
One of the things, because I heard you speak at Raise Fest, we briefly met. We're both part of the Entrepreneurs Organization. That's how I originally got connected with you. And then I heard you speak at Raise Fest. And one of the things that was really interesting is you'd said that you could come into a DST very late in that process and close in a very short amount of time. What does that look like?
yeah, because this is already done. It's a prepackaged deal.
Yep.
It's like taking a frozen pizza and throwing it in the microwave instead of making it from scratch, which it seems most real estate deals really feel like.
Yep.
Um, Yeah, so the three scenarios. There's a lot. I can get really deep and nerdy on this stuff. There's more. I can do some very advanced planning and strategies. But the three typical scenarios are: one, uh, you're selling your property because you're sick of the terrible T's, right? So, and you know you're going to the DST. It's a pretty easy process. The other two places are, you're in your 45-day identification period for your exchange, and your deal just blew up. You're on day 44, and tomorrow at midnight, you've got to identify. Causes I get a lot of panic phone calls late at night and on Saturdays and Sundays sometimes. Fine with me. I love it, actually. And this deal's in place. It's not going to fall through. Everything's
Yep.
been done. There is no due diligence. There is no weird environmental. There is no going back and forth negotiating. It's done.
Yep.
So you're going to say, I'm going to identify this, and you don't put your money into it last minute, or maybe you're worried your deal won't go through, but you're not going to know for 90 days. Well,
Hmm.
45 days, you're past your identification point. You're still hoping your deal goes through. You name a DST as a backup. Just, cover
Hmm.
your ass, so to speak. Name a couple as a backup because I see it from time to time. The deal
Yeah.
falls through. Shit happens in real estate. And it's really nice to have a backup where you don't just pay 500,000 in taxes because you hope one deal went through and lo and behold there's asbestos and you don't want to pay to have it replaced, right? Whatever the reasons
Yeah.
are. And another very very common is boot, where you got money left over.
Mm.
Weirdly, that's like the technical term for money left over in exchanges is boot and taxable. So, you sold a $10 million property. You found a property you love for 9.5 million. What do you do with that 500 grand? Well, most people
Mm.
just pay taxes and walk away. Um, in this circumstance, no, you don't. You take that 500 grand and let's put it in a DST.
Yep.
And there you go. For your taxes, all your money's working for you. And everyone but the IRS is happy.
Yeah. Well, I love that. So it can be DST can be like one of the three properties you identify within the 45-day window, um, either a primary property or a backup property, whatever it might be. But let's say we're in the last week of the 45 days, and would I be, as one of my three properties, am I actually like earmarking a specific DST property, or is it any DST? Does it have to be a
No,
specific
you have to.
DST?
The IRS rules are very specific. You have to list an address or a plot number, a
Yeah.
tax identification number, right? So every DST is its own address. If it's a DST that has multiple properties, then we would list every address on the property. And you mentioned three properties. That's not the only way to identify. It's
Yep.
the most commonly known, but you can identify many more than three properties and you
Yeah.
can do multiple identifications. I'm not a qualified intermediary last night. Excuse me, not a qualified intermediary, but I do enough of this. I can really help you out with your
Yeah.
identification and your exchange. There's a lot of tricks and tools you can use. So
Sure. And how would it work? Because I imagine normally, like you're constantly selling these DST shares, right, until it's sold out. So if this was, let's say, like a backup plan to a property specific 1031 exchange, and I had up to 180 days from the close of the down leg to close, I got to make sure that there's room in this DST specific property that I listed. If we're only doing three in that one example, rather than, I know the rule gets a bit more complicated, but let's just assume for now the three. I have to make sure there's still room for me, 100 days down the road, right?
absolutely correct. And this has been a problem, and it's slowed down. Things are a little more calm now than they were 2 years ago. I used to lose sleep at night if someone would call me with $10 million, and
Yeah,
I'm like, I got the inventory for you.
yeah,
But yeah, it can happen if you're not careful. If that DST sells out, they won't hold. They're not going to hold equity for you for 2 months. They want money talks, BS walks, right? So they're going to,
hmm,
hey, that's great. We'd love to have you as an investor, but Bob over here, he's ready to wire the money. So you could lose out. But I do everything I can to make sure that doesn't happen. I'm going to consult with you and say, hey, I know you like this DST, but it's only 2 million of equity left. It's not going to last 30 days. This
yeah,
one's got 180 million of equity left. This is a better option to identify, and we do. My broker dealer, Concord Investment Services, they do vet all of these DSTs. We don't work with just any sponsor or any program on the market. We do background checks on these principals. We look at their track record. We make them give us third party due diligence reports. We make them even give us an independent legal opinion saying that it in fact is a DST and not a REIT or a partnership. So it doesn't blow up
mm,
the exchange. And even if it's a sponsor we've done 1,000 deals with, we will still sometimes say, hey, not this time, don't like this neighborhood, don't like the city, don't like this asset, whatever it is, we'll pass and we won't
yeah,
offer it to our customers. So we do a lot to protect. So if I'm showing you something on the menu, it's at least a legitimate deal. Doesn't always mean it's going to be the best deal. But at the end of the day, my firm does everything we can to protect you as an investor.
yeah. So along that thought process, so you guys are still you guys are partnering with the sponsor who's still running the deal, doing the asset management, doing everything else for the deal, and you guys are helping with the equity portion of the deal. Is that right?
Yeah, I'm literally just like a salesman. I mean, you could say. I mean, if you want to really get down to it, I'm a broker. I'm a salesman. I represent you as a customer, and I literally show you the menu of available options and help get you in the right DSTs that fit your whatever needs you have, debt needs, sleeping at night needs,
Yeah.
whatever it is you need to accomplish. I'm going to do everything I can to make sure you accomplish that. So I don't actually, I'm not partnering. Bangerter Financial's not partnering. I'm simply, literally a sales force. You
Yeah.
have to have a Series 7 license to sell these products. So real estate agents can't do it. CPAs, attorneys can't do it unless they have those licenses, which they typically don't. Very, very highly regulated by the SEC and FINRA. So there's a lot of government oversight. Don't forget the IRS wants these structured a certain way. I would say these are the most researched, vetted, due diligence, scrutinized real estate product in the world.
Wow.
So
Crazy. Okay, so that helps a lot. So we kind of understand how you get into it. What about in terms of like holding periods? Do those vary between deals, and what do the exits look like?
it's obviously different for every single DST. It is 100,000 minimum. It's very easy to diversify and get into different multiple DSTs. They're all going to have different exit time frames. Some companies have specific products where they say, "Hey, we're going to do have an exit in 3 years or an exit in 4 years." Most DSTs will just say, "Hey, we're going to sell when the time is right." The average hold time is 5 to 7 years.
Yeah.
For example, they almost never will go past 10. And the
Okay.
reason for that is if the DST has financing, most commercial debt is a 10-year balloon. Well, the IRS says you can't refinance the debt barring financial catastrophe. So that property, and that's got to be paid off in year 10. So that property is going to be sold before then. So it is a lot of work. It's a lot of research and due diligence. Finding a property that you feel is going to appreciate and you'll be able to exit easily before 10 years and at a profit. Why buy a property to exit it at a loss? It doesn't make any sense, right?
Hmm.
So that's really, I tell people, look, it's on average a 5 to 7 year time frame. There are some sponsor companies out there that do have some kind of earlier exit options, some different strategies you can do. We don't need to get in the weeds on that, but at the end of the day, that being said, you do own the units. They're yours. You can transfer them, sell them if you would like. It's not as easy as putting a for sale sign on your duplex, but
Mm.
it can be done, but it can take 3, 4, 5, 6 months to accomplish. And you're probably going to get lowball.
In that example, you're talking about the individual investor showing selling their shares within the DST. Yeah,
Yeah, yeah.
gotcha. And
And they're
what does
called
it look like?
units because you can't 1031 shares.
Yeah,
It's an IRS. So,
yeah, yeah,
yeah.
yeah. Glad you've done your homework over 25 years. What does it look like in terms of let's say that individual investor and they stay through the entire hold period, 5 years, 10 years, whatever it is. What does it look like on the back end if they want to continue to do a 1031 exchange?
So the sponsor company is going to contact them. Hey, we're under contract. We close in 90 days. We'll update you with more info, right? And then as it gets a little bit closer to closing, they say, hey, what do you want to do with the money? Do you have a qualified 1031 intermediary you would like us to send the money to? Do you want us to just send you a check and not worry
Mm,
about the tax? Just pay the taxes. And so whichever accommodator you choose, that's where they send the money. And then the 1031 exchange process starts all over again. Quite commonly, I would say 90% of the time, people go back into another DST once they're there. They're pretty happy with the completely hands-off approach. But you
yep,
don't have to. You could take that money and go buy a storage, units or an Arby's or whatever it is you want to buy.
yep.
So it's just a regular. It just becomes another 1031 exchange. So 1031 exchange is a 1031 exchange. A DST is just an option instead of 123 Main Street.
Gotcha.
So
Okay. And it doesn't matter. It doesn't matter what any of the other DST shareholders are doing with their money. You can decide
no,
what you want to do with your
very,
shares.
very different than a tick. There's no voting. There's no arguing. There's no the DST sponsored. They call the shots. That's what happens, and you're along for the ride.
Yeah.
So
Yeah. Yeah, I mean, it sounds like it's a great solution for being really hands off, and you're right. A lot of people that want to just stay wealthy and deal with less headaches, the terrible T's. I
yeah,
see why it's such a great option.
yeah, and a lot of don't get me wrong, a lot of these, the multifamily storage hotels, a lot of them do get very good returns. You
Yeah,
know, we've had a lot of people double and triple their money in these programs, especially recently.
yeah,
So what I say is keep your rich money doesn't mean they don't make money. It's just I tell people, don't count on. I don't know to use a baseball analogy. They're not made to really hit home runs or singles and doubles, kind of hitters. So.
yeah, yeah. I love it. What is how does the fee structure vary versus a normal syndication? What does that look like?
I'd say it's a little bit more expensive. It's more expensive to syndicate a DST. There's a lot more legal work, first of all, and they're just more expensive to get it up and running. And typically, someone's doing it for you, so the syndication on average is more expensive than if you went and bought it yourself because you're
Mm,
paying somebody else to do it for you. So no doubt
sure.
about it, a DST is more expensive than if you went and bought a fourplex on your own.
Yeah.
That being said, when it comes to things like property management fees, they tend to be lower because you're dealing with a firm that maybe has 40,000 apartment doors. And so they've got a management company charging 3% of the rent instead of 8 to 10,
Mm-hmm.
right? They're tending to get better rates on loans because they've got the capital and the collateral and the credit to negotiate better terms than you or I can, Chad.
Yeah.
But yeah, I mean, it's a little more expensive, but as I like to say, you could mow the lawn yourself or you could pay someone to do it and then enjoy a couple hours of free time. So,
Yeah. Yeah. That's a good analogy.
but
We're all trying to buy time. I get it.
yeah, and
What?
that's what they really give you your time back.
Yeah. What is the I guess like the pipeline of deals look like? Has that changed for you guys over the last year? Like, I mean, I know that a lot of transactions are down. What does the selection look like for you guys right now versus a year ago in terms of like the number of DSTs that you were offering as options?
Well, certainly when things are good and the DST market is booming, it's gone from a $1 billion marketplace 10 years ago to last year it was almost 11 billion.
Wow.
Um, so we've had more players come into the space for sure.
Hmm.
But I would say I think we have 1.6 billion in equity available currently through over 50 offerings.
Jeez.
Where a
Okay.
year and a half ago it was like I maybe had 15 offerings with equity and maybe it was a couple hundred million available.
Oh
So it's
wow.
definitely slowed down. There's still transactions. I'm still really busy. Um, but it's certainly not like where the phone's ringing off the hook and people are panicking because there's nothing to buy,
Yeah. So
right?
so if someone called you today for a DST investment, how many options would they have to choose from right now?
Well, like I said, I've got over 50 options.
Wow.
And
Okay.
then I just start looking at things like, well, do we got to replace debt? Are you all cash? You don't want debt. Okay, well, there's only so many all cash deals. If you don't want debt, like you don't like storage units, or I don't want to do medical. I kind of help people. What helps you sleep at night? Oftentimes people just say, Ray, I don't know. You just tell me what you think some good ones are, and that's what I'll
Yeah.
do. But people have opinions. Sometimes they may be weird, but I honor your wishes. And if you don't want me to talk about Florida because your girlfriend cheated on you with a dude from Florida, I'll never show you a multifamily unit in Florida again. So,
Yeah. Yeah. Yeah.
so
But you do have like those kind of 50 just as an example for what you have today. That's across all different types of asset classes.
yeah, I mean, multifamily is easily 800-pound gorilla
Mm,
in the room. Typically, 50 to 60% of DSTs are multifamily. The asset just tends to work really well in a
yeah.
DST. But yeah, we've got, there's some student housing deals. There's always storage. Got some medical. Got some industrial. Several different triple net offerings. Um, I mean, geez, really, seriously, I think the only asset class we don't have is like cannabis. You
Yeah.
know? So,
Yeah. Wow.
we've got all sorts of and major stuff like Amazon distribution facilities. We've got like Walgreens, like regional headquarters. Right. We have an NFL practice facility right now in a DST. I think that's a pretty fun one. And
Cool.
we also do highly leveraged DSTs. So if you've got a lot of debt to replace, we've got highly leveraged ones. But I can also use those highly leveraged ones to help you replace your mortgage and let you take your cash, the rest of your cash, and just go buy your own property. So there's a
Yeah.
lot of really creative things I can do for you,
Yeah.
and it's actually, if you know what you're doing in this space, there can be a lot of cool things that happen. So.
Yeah. Well, along those lines, in terms of creativity, what's an example of one of the most challenging DSTs that you had to, in terms of getting across the finish line? What's a good story you've got?
As far as for an investor,
Yeah, either an investor or what you had to do in terms of getting creative. What's like a really unique transaction that was pretty tough to get over the line that you were able to make work?
oftentimes it's. I mean, I'm able to help people. Oftentimes, you own a property in an LLC, and there's seven owners, and three of them don't want to do it. Welcome to Ticks. Uh,
Yeah.
and so we know ways to kind of help break up the LLC and let people do their own exchanges. A really good example of a debt thing I really helped somebody with was, there was a guy, a customer of mine here actually locally in the Salt Lake area, sold a strip mall for $16 million. He had $4 million of debt, and he liked DSTs, but he's really like, I want to do it. I want to control the real estate. I want to be passive. I want to sell it when I want to sell it, right? Like a lot of real estate investors are like that. But he said to me, Ray, I'm 78 years old. I don't want to go get a $4 million commercial mortgage. I
Hmm.
don't want to deal with it, but I've got to replace this. So what we did is I showed him a highly leveraged DST, and the asset was actually the Zurich North America's corporate headquarters in Chicago. It's like this gigantic, campus,
Hmm.
and that was in a zero coupon. DST is 80% loan to value. They take all the lease, Zurich was paying, and they're paying down the principal on the mortgage. So what he did is we did the math. He had 12 million of equity in his exchange. We took like 1.5 million roughly, invested into this Zurich headquarters, this high leverage DST. That got him that four something million of debt.
Hmm.
He then took the remaining 11.5 million, or 10.5 million, excuse me, and went and bought his own properties with no debt on them. So he no longer has a mortgage. He didn't have to deal with getting a mortgage. Didn't have to deal with mortgage payments. Didn't have to
Hmm.
do a credit report. Oh, and by the way, the money put in that Zurich thing is averaging about a 7 to 8% IRR a year. He's making money on it, but he doesn't have a mortgage anymore. And all these other properties, it's free and clear, and he's getting the cash flow on them, and he's never been happier. And
Nice.
he refers to friends and family all the time. So
Wow.
that's a little more unusual one we did.
So
I
the
did.
premise of that one was he did one investment with you to kind of to meet the requirements for the debt requirements for the 1031 exchange, and then that allowed him to be 100% owner on the other properties that he would have no debt on, and he would be the operator owner of.
Correct.
Okay, cool.
Yeah.
All right.
So a lot of deals like that all the time. I've ended up being backups for people where their deal fell through. The boot scenario. I haven't seen it all, but I've seen a lot.
Yeah.
So,
Nice. What do you think would be the best way if people wanted to learn more about DSTs? What are some resources you could point them towards besides calling Ray?
just call me, call me, call me, call me. The website bangerterfinancial.com. My business partner wrote a book called "Are You Tired of Tenants, Toilets, and Trash?" We do webinars on a weekly basis that you can sign up for. I travel around the country, do seminars. Going to Houston in 2 weeks and doing some seminars. I am actually personally. So the best way is just call me. I'll talk to you.
Cool.
Get you whatever info. It for me, I don't look at it as like a sales process. It's an education process. And if this product works for you, you're going to do it. If it doesn't work for you, you're not.
Yeah.
That plain and simple. So
Okay. So the best way for people to get a hold of you, phone or email, what do you think? What's best?
yeah, either one, 801-815-6619. And Ray at bangerterfinancial.com. You might have to put a little graphic up there to show that, but
Yeah, I'll pop it up.
definitely get a hold of me. I'll take care of you.
Okay. Yeah, I love it. I mean, this has been super helpful getting me and the audience educated on it. It's a great way to postpone paying taxes, avoid paying taxes. I've been a big fan of the DST. I've learned most of what I know from you, so thank you for sharing with me over the time I've known you, and enjoy seeing you at the conferences and the EO, and just really appreciate you, Ray.
Yeah, thanks. Anytime, I'm happy to be here. So,
Sounds good. All right, we'll get this published. Thanks so much.
yep, you got it.
All right, we've heard from the expert Ray, who spells his name DST. He's a super friendly guy and very helpful. So if you'd like to learn more, feel free to give him a call or email him. And don't forget to subscribe to our YouTube channel and drop us a comment below. Let us know what you think. Thanks a lot.